Hello everyone, today we are going to talk about everyone's favorite subject, taxes. I am excited to walk through some of the helpful education, common myths, and proven planning concepts that can help you better understand how the tax system works and how are people legally managing their tax exposure. If we haven't met, I am Joel, CEO of Flames Financial Planning. We are a flat fee financial planning firm where your investment management, financial planning, tax filing, and estate planning are all included in one comprehensive membership. So let's start with a key foundational concept: the difference between your marginal tax rate and your effective tax rate. Your marginal rate is the tax bracket where your last dollar of income falls into. That is the percentage of tax you'll actually pay on your next dollar earned. But your effective tax rate is the overall average tax rate, the actual percentage of your total income that goes to taxes. Let's walk through a quick visual example. This is how our progressive tax system works using the 2025 federal tax brackets. Your first dollars are taxed at the lowest percentage rate. In this example, the first $11,925 is taxed at 10%. The next $36,550 is taxed at 12%. The next $54,875 is taxed at 22%. And the next $93,950 is taxed at 24%. In this scenario, the total taxable income is $197,300. The estimated federal tax bill is $40,199, which puts your effective tax rate at roughly 20.4%. This helps us bust one of the absolute biggest tax myths out there, that making more money is bad because it might push you into that next higher tax bracket. That's just simply not how our tax system works. You only pay the higher rate on the portion of income that falls and crosses into the next tax bracket. It is almost always better to earn more money and pay some additional taxes than to just avoid that income entirely. So the real question, how do people actually reduce their taxes? The answer really depends heavily on what stage of life you're in. If you're in your working and accumulation years, two of the most powerful tools are the Pretax retirement contributions and health savings accounts. Maxing out a Pretax 401k allows you to literally reduce your current taxable income. In our simple example, contributing the full $24,500 could reduce your federal tax bill by roughly $5,900 and potential state tax savings as well. Actual results completely depend on your full financial picture. Health savings account, or HSAs, are another incredibly powerful tool. If you're eligible, they offer a rare triple tax benefit: tax-deductible contributions, tax-free growth, and tax-free withdrawals when used for qualified medical expenses. But what if you're already retired? How do you manage lifetime taxes once you're no longer earning income or contributing to traditional qualified retirement plans? Well, here are a few important concepts. One common strategy retirees often explore is called Roth conversions. This involves intentionally moving money from your pre-tax retirement accounts into Roth accounts over a period of time. The goal is to create long-term tax efficiency, manage future required minimum distributions, and potentially reduce your overall lifetime tax bill owed. One way I do this for my clients is using Holistiplan tax software to simulate a full tax return. This allows me to put in your income, deductions, tax credits, and review the applicable tax brackets. Then I can preview your estimated tax bill before anything is finalized, so we can proactively optimize your strategy rather than react afterwards. This process requires careful analysis. When done properly, it can balance the current taxes with long-term benefits, while also monitoring factors like Medicare premium surcharges and future income thresholds. Another important area is gifting strategies. Due to changes in inheritance rules, many beneficiaries now only have 10 years to fully withdraw inherited retirement accounts. This can create a significant tax burden. In some cases, gifting while alive within the IRS guidelines can be a powerful way to help family members when they need it most and potentially reduce your future tax strain. Gifting strategies should always be coordinated with your full financial plan and your estate plan. Lastly, let's talk about deductions. Each year, you'll take either the standard deduction or the itemized deduction, whichever is higher. For 2026, the standard deduction is projected to be $16,100 for individuals, $32,200 for married couples, with also added benefits for those who are 65 or older. Itemizing still may make sense if you have significant mortgage interest, charitable contributions, or state and local taxes. But one major change they made for the 2025 tax filing was the SALT deduction cap, being raised from $10,000 to $40,000 with inflation increases going forward. Tax planning is all about understanding which strategy best fits your situation each year. So what's the big takeaway? Taxes impact nearly every major financial decision: income, investing, retirement planning, charitable giving, and estate planning. If you found this helpful, hit that subscribe button for more financial education just like this. And if you would like to learn more about our planning approach and how we help our clients, you can find additional education resources and firm information in the description below. Thank you so much for watching, and I'll see you next time.